Okay, let's kick things off with a quote that sounds totally backward, right? The economist Hyman Minsky once said, "Stability is destabilizing." How on earth can that be? Well, we're about to find out how 30 years of what felt like unprecedented calm may have been secretly planting the seeds of its own destruction. In this explainer, we're diving into Act 1 of a really fascinating white paper called The World They Built for You. We're going to tell the story of the financial environment that shaped an entire generation of investors, an environment that felt permanent, right up until the moment it wasn't. So, how did we even get here? Well, the story really gets going in the late 1980s. The wild economic swings of the 1970s started to just fade away, and they were replaced by this unprecedented, almost unnatural calm. Recessions became shallower, inflation became stable, and markets just seemed, well, easier. Economists even gave it a name: the Great Moderation. Now, this 30-year calm wasn't just one single monolithic period. It was actually two distinct eras. First, from 1990 all the way to 2008, you had the Great Moderation. Think low inflation, brief recessions, and this growing belief that central banks had everything under control. Then, after the 2008 crisis, a whole new era began: the central bank put. This is where central banks didn't just manage the economy, they explicitly started saving the markets whenever things got scary. To really grasp just how strange this calm was, you have to compare it to what came before. The 1970s were pure chaos. We're talking oil shocks, stagflation, that's when you get high inflation and a stalled economy at the same time, and interest rates hitting an unbelievable 20%. Then came the Great Moderation, and suddenly the volatility of the entire US economy was cut in half. The VIX, the market's fear gauge, spent most of its time just snoozing below 20. It was a completely different world. And this new world taught investors a very powerful, very simple lesson. After 2008, every single time the market stumbled, in 2013, 2015, 2018, and most dramatically in 2020, the central banks came riding in like the cavalry. The lesson was hammered home again and again and again. Whatever you do, don't panic. Just buy the dip. The system will save you. An environment this stable and this predictable naturally led to a standard playbook for safe investing. And at the very heart of that playbook was one of the most famous strategies in modern finance: the 60-40 portfolio. So what is it? It's actually beautifully simple. You put 60% of your money in stocks for growth and the other 40% in safe government bonds for, well, safety and income. For decades, this wasn't just a strategy, it was the strategy. It was the very definition of prudent, sensible investing. And the logic behind it was just as elegant. It was built on one key assumption about how the world works. When the stock market gets into trouble, bonds are supposed to go up. So why is that? Because during a crisis, investors sell off their risky stocks and they flee to the safety of government bonds, which pushes their prices up. The 40% bond part of your portfolio acted like a perfect natural shock absorber for the 60% stock portion. It was a beautiful, self-balancing machine. And this wasn't just a theory, not at all. For 30 years, the data was crystal clear. The average correlation between stocks and bonds was negative. During a crisis, it got even more negative, meaning your bond hedge worked best right when you needed it most. It delivered a solid 8% average return. And even after the massive 2008 crash, yeah, it was painful, but it was completely recoverable. It just worked. But this is where our story takes a bit of a dark turn. This is where Hyman Minsky's ghost comes back to haunt us, because that long, wonderful period of stability and success was creating a hidden danger. A Minsky moment was building just beneath the surface. So we have to ask the question that Minsky would have asked. What if all that calm wasn't a sign of strength? What if instead it was creating the very conditions for a massive, unexpected crisis? What if the system was becoming more fragile, not less? Minsky's theory breaks it down into 3 stages. You start with hedge finance, where everyone is conservative and can easily pay back their debts. That's stable. But success breeds confidence, and people move to speculative finance, where they can only afford to pay the interest, not the principal. That's getting fragile. Finally, you get to Ponzi finance, where borrowers can't even pay the interest and are totally dependent on asset prices constantly going up to stay afloat. The crucial point is that stability itself, prolonged success, is what seduces people down this path, from conservative to fragile, and finally to reckless. So where was this fragility hiding?
everywhere. It was in UK pension funds, using £1.5 trillion in leveraged strategies. It was in the yen carry trade, a massive bet where investors borrow money cheaply in Japan to invest elsewhere for higher returns. It was in passive index funds, which had concentrated over a third of the S&P 500's value into just 10 giant stocks. And it was in corporations that took on record debt, not to innovate, but just to buy back their own stock and boost its price.
And this brings us to the human element of the story, which might be the most important part. You see, a 30-year era of calm doesn't just shape portfolios, it shapes people. It creates an institutional memory gap, a generational blind spot. Think about this. Every single portfolio manager under the age of 40 has never, in their entire professional career, had to manage money through a period of sustained high inflation. Their entire playbook was written in a world where inflation just wasn't a problem. Let's think bigger. Every risk manager under 50 has never experienced a true, prolonged bear market in bonds. For their entire careers, interest rates have mostly gone in one direction, down. They've been trained to see government bonds as the ultimate risk-free asset. And perhaps most critically, every chief investment officer under 60 has never had to allocate capital in an environment where stocks and bonds fall together for years at a time, not just for a few months. The very foundation of their safe playbook has never been truly tested during their tenure. So this all leads us to a deeply uncomfortable question. What happens when the world that shaped these investors, their models, and their portfolios suddenly changes? What if this 30-year era is actually over? What if central banks, after famously getting the transitory inflation calls so wrong, have lost the unquestioning trust that allowed them to call markets with just their words? What if the magic is gone? What if governments, now burdened with historically high levels of debt, simply don't have the financial firepower, the policy space, to bail the system out the next time a major crisis hits? What if the cavalry isn't coming this time? And this brings us to the most dangerous question of all. What if that perfect negative relationship between stocks and bonds, the very engine of the 60-40 portfolio, wasn't a permanent law of finance, but just a historical anomaly, a lucky feature of a 30-year period that is now behind us? And that leaves us with this final, chilling thought. The world that an entire generation of investors was trained for, the world that validated their strategies and shaped their every intuition, may simply no longer exist. And the question we all have to face is, what comes next?